CPI report out this morning. What does that mean for the markets, short term and long term? That's coming up on 3 Minutes on Markets and Money. The most watched indicator as of late is coming out this morning, and that is the CPI, the Consumer Price Index inflation rate, showing whether or not there was inflation on a month-over-month basis, and particularly on a year-over-year basis. Have we seen peak inflation? That's the big question. Why is this important? Because this all has to do with the Fed. Again, we take a look at what's going on with the markets. Markets are now solely dependent on what the Fed does. Monetary policy, that's all that matters. Is the Fed going to hike rates more? Are they going to start cutting rates? Are they going to do QE or QT? That's what's driving markets right now, not fundamentals, not technicals, really more than anything else. All eyes are just simply focused on the Fed. So this morning, expectations are that we'll have a negative CPI print on a month-over-month basis. Now, if that is the case, then what we're going to see here potentially is a lot more talk, and potentially a market rally here, of expectations the Fed will pivot off of their more aggressive monetary policy, right? 75 basis point rate hike on the table for the end of this month. That's pretty much a locked bet right now. But the question becomes after that, will they start slowing that pace, right? If we start to see inflation coming down, Fed doesn't need to be as aggressive. So if the Fed starts cutting rates, theories are that markets should continue to rally here as, potentially all this has been priced in. Of course, this all assumes a couple of things. One, is the Fed pivoting on their rate hikes because of just inflation coming down, but still have strong economic growth, strong employment, strong earnings growth? That's going to be the question here. If they're continuing to hike rates, and expectations are right now for the Fed to go to 4 to 4.5% on the Fed funds rate, if that's the case, what if we begin to see slower economic growth, slower earnings growth, and of course rising unemployment? That certainly doesn't bode well for the markets, but that would be when the Fed would be starting to cut rates and talking about going back to QE. So a bit of a disconnect right now between the markets and the Fed. Markets are rallying in expectations the Fed will slow the pace of rate hikes, but the Fed is not going to reverse and start creating monetary accommodation until we begin to see much slower rates of inflation, and especially recessionary conditions in the economy. So again, when we take a look at the market short term, yes, lots of bullish action here short term. Markets are about to trigger a MACD buy signal this morning that suggests that markets could rally back here to around 4250 on the index. That's about where the 200-day moving average is. Markets are moving back into overbought territory as well. Upside still to about 4,200, 4,250. That's likely in the short term. Nice tradable rally from a short term basis, but on a longer term basis, if you're kind of a longer term investor, may still want to be paying attention to this overall kind of downtrend in the markets until that is broken. We're still dealing with this head and shoulders pattern that we talked about the other day. Right now the market's still trading below that neckline. So until those are reversed, may want to remain a little bit more cautious. Use the rally to rebalance risk, raise a bit of cash. Certainly a tradable opportunity here, but don't be too aggressive until we start seeing real dynamic change in both the technical and fundamental case of the markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.